Well, there it is, team. We talked about this a couple days ago. There was a different yield curve inversion that took place. Now the mother yield curve inversion has taken place. The 2-year Treasury has topped the 10-year. This yield curve inversion has signaled a recession. 66% of the time it happens. Let's see, it said it down here again. Better than 2/3 chance of a recession at some point in the next year, and greater than 98% chance of a recession at some point in the next 2 years. The last time this happened was in 2019, and I remember because I had Barry Beebe on my radio show, and he basically said, hey, I'm thinking about buying bonds. I think there's going to be a refi boom. There's going to be a recession. I think there's going to be cutting. And he was exactly right. And that was in 2019, right when the yield curve inversion was taking place. The recession was short-lived. COVID sort of just changed everything. And so it's hard to say, what will happen this time. It always is, right? Anything could happen, always. But this is not a great sign for the economy. So what does that mean for real estate? That's what we want to kind of dive into today. What does it mean for real estate? What does it mean for the Fed? What does that mean for mortgage rates? What the heck else is going on out there? Going to try to take a look at all these things today, but it's definitely not a situation to panic, not a situation to just
check, please,
exit stage left on anything. But I do think we're going to see some serious pressure on stocks today. And in fact, I believe, you had the yield curve inversion today. Dow drops 500 points to end worst quarter for stocks in 2 years. So pretty much worst quarter for stocks since last time this happened. Now, I know I've been stock bearish for a long time, and over that period of time, stocks are probably pretty flat. But this is kind of something that has to come at some point, just with where valuations are in stocks. And it wouldn't surprise me if it coincided directly with Congress enacting some rules that are going to keep them from participating in stocks. They'll get out, and then they'll make a rule that they can't trade it anymore. But this yield curve inversion, a couple things to really know and make note of on this is signal for recession. It's not 100% accurate. So it is a signal. The one from a couple days ago, also a signal. This is a stronger signal. And so if that means a recession is coming, what does that mean? Well, we've already got 5 million more jobs than there are people unemployed. So it feels like we have some cushion there to lose a little bit on the economy and still be okay. Stock's very high right now. They're probably going to come in some. Real estate has done well during recessions. So that's one thing we've covered, I know, extensively on here. Let me get myself out of here. I'm going to start pummeling through some of this. Today, we'll just run through mortgage bonds really quick, and then I'm going to look at the data was out today. So we have last week's data, average mortgage rate, 4.67%, almost exactly where I predicted it to be, amazingly. And so no victory laps here, though. That's just not how we roll. But also, as predicted yesterday, this was going to be a tough area for us to get through, right? Or not yesterday, 2 days ago. I predicted this was going to be a tough area to get through. And in fact, you'll see we haven't been able to close above it. And in fact, now we've closed below it. We closed right at it yesterday. We've closed below it today. It's just a hard time for bonds. Hard time for bonds with rates like this. Hard time for bonds with this type of situation that's going on across the world. It's just a tough time for bonds. You'll notice here some more great news. Mortgage refinance demand plunges 60% as rates hit their highest level. To all my realtor friends out there, this is why you are getting so many phone calls from lenders who want to.
All we want to do is pump you up.
I know how I feel. I know what it's like. It is what it is. So refinance demand is down. Mortgage rates are definitely up. Today, even though we're down a little bit, down 12 basis points today, rates relatively flat in comparison to yesterday. Not a whole lot. We're not going to run through and pull individual rates today. You can look at the one from yesterday and the day before if you want to see what rates are like. They're pretty much the same. Of course, if you want a custom quote, just submit your scenario. Email me, text me. All I need is loan amount, the purchase price or home value if it's a refinance, your credit score, whether it's a condo or detached. The main thing we need right there. And I can get you a custom quote, tell you exactly what it should look like for you based on that. Okay, so we're not going to run through rates in specifics today, but I'm going to look at the rate chart. Now, this is going back to the beginning of 2021. The reason I went back there is because that was kind of like the perfect time to refi. Saw rates get down. The average rate. Imagine that the average rate was 2.67, 2.65. That was the average rate. Crazy, right? I mean, it's just insane opportunity. And we were screaming from the rooftops, and a lot of people took advantage of it. It worked out great for a lot of people. It was amazing. But as you can see, rates have sort of trickled up since, particularly, since the beginning of this year. So if you go right here, this is sort of the end of 2021. You see this little tick up here at the end, but then just from there, it's just very little pauses before we reach to where we are now, which is data released today through last week, which shows you 4.67% is the average mortgage rate. The source is Freddie Mac on this. I'm getting this from the St. Louis Fed website. I'll put the link in the description if you want to check it out. This is something that I would bookmark and just kind of keep an eye on. It helps you zoom out. You can really see where mortgage rates are. Now, if I take this back, a ways, you'll see that rates are down quite a bit, historically speaking. The further I take this back, the more down you're going to see they are. But if we zoom in and we look more closely at just what's happened recently, we can see, rates have definitely spiked. So there's some pressure there. There's some pressure on rates. There's pressure on bonds. Yield curve inversion makes sense. What happens next? I think real estate continues to be a safe haven asset. That was proven in COVID. We saw that when people thought that you were going to be going to the grocery store and stepping over dead bodies to get bread, they bought real estate. So the market has already spoken to us about this. They've already told us that in a time of crisis, we're going to run to real estate. Will they do it when rates are high and prices are higher than a few years ago? That is a question. It is a question. We know that some demand has been taken out of the market. It has. I just re-upped the pre-approval for someone who got pre-approved at the end of last year. He was approved for $750 before. Now he's approved for $650. Just as it is what it is. So it is changing things for a lot of buyers. It is, but we haven't seen it negatively impact the market yet. And will we is a very big question. I feel that, this, when you see, okay, a recession is coming, what does that mean? In the next year or two, will we see, a depletion? We will see job growths go negative. Will we see the stock market go negative? Will we see consumer spending get reeled in? And that's one thing we have right now. Inflation's so rampant. We've got consumer spending that's really, really good. I mean, people, you can't even buy stuff. Do you realize this? Does everybody else know this? You can't even buy stuff right now. It's like we tried to buy a couch. We actually went to the store, picked one out, and we're like, okay, that's the one we want to get. Like, okay, it's going to take about 6 weeks. That's the average right now. We're like, wow, okay, 6 weeks to get a couch. Cool. All right, so be it. Let's get it. Like, actually, you have to order it in separate pieces, and you have to wait until they're all available. So just keep checking on our website. It's Living Spaces, by the way. So we didn't get a couch. There's people who are trying to spend money, is my point. That's how much money there is. And there's supply chain issues, which is what they were telling us was the issue. There's different reasons why, products aren't available. And there's more of that coming too. So I'm going to pile on a little bit here. And this is not intended to be anything other than just sharing this with you, because this is an incredible thread that I highly recommend checking out. I'm going to include this link in the description as well. This basically just shows you could go, if you start at the very top here, it begins with, and it shows some different things on Twitter, but basically the ruble, the Russian ruble, regained 100% of its loss. So the economic sanctions that we impose, which are supposed to decimate the ruble and really hurt Russia and their economy, already completely reversed. Completely reversed. And there's multiple reasons for this, but it's just kind of proof that, like, when you try to slap economic sanctions on a resource-rich nation, it can backfire. And so this is something that, coupled with, I'm not going to go through all these, though I recommend you read this entire thread. It's really, really good. This just happened. Russian central bank is going to restart buying gold from banks. They'll pay a fixed price of 5,000 rubles per gram. So they are going to, Russia is basically going back to the gold standard. That's what they're doing. They're going back to the gold standard, and that is going to protect their currency. It's going to protect the people who have their currency, and that's part of the reasons why it's rallied back to where it was before. In fact, it may even start strengthening against the dollar in the near future. Here's what I wanted to bring up, though. Russia and Ukraine combined account for about 30% of the world's wheat exports. This is, by the way, a New York Times author and an article there. 17% of corn, 32% of barley, 75% of sunflower seed oil. Russia also exports about 15% of the world's fertilizer. Now all that food and fertilizer are stuck. So that has to have some sort of implications. This is inflationary implications. Okay, so if you have inflation with a recession, you've got stagflation. That could be problematic. Also would be good from a real estate perspective. Any type of inflation, stagflation, it's going to be good for real estate or hard assets, or should be, but maybe not so good for people who are saving cash, or maybe not so good for people who are going, well, I'm losing money in the stock market now. My income isn't going as far because things are costing more. It can cause a sentiment issue, and the sentiment issue is the main thing that we have to keep an eye on here. So while we're watching, mortgage rates are spiking now, that we haven't really found a level yet where, it's still just kind of in a parabolic move higher as a result of what's going on with, the Fed saying they're raising rates. They're going to stop buying bonds. It's caused problems. We've been charting this for quite some time right now. This isn't a surprise to anyone who's been watching this channel. We've been watching this whole thing take place. We know the acceleration of these different curves and everything that's going on here. It hasn't been pretty for some time. The market has anticipated this weakness for some time, and now you're really starting to see it show up in mortgage rates. You're really starting to see it across the board, not just in one particular program, across the board. So will this have an impact? I do think that this will ultimately have some sort of impact on real estate. But I think what it does is it really starts to flatten the curve a little bit. I've talked to a lot of listing agents. They're saying things that are along the lines of, we're still getting high quality offers, not as many. But then I also have, deals where we're in offers and I have listing agents calling me going, I have 30 offers. So it hasn't slowed things down a ton, but part of the reason for that, and this is what we need to track next. This is the next most important metric. Part of the reason for that is that the people who are out there writing offers in the market right now, these are people who, were a part of the boom. These are people who've been looking for a while. They've watched prices go higher. They've seen inventory decrease. That's what they understand of the market. New buyers who are coming in, getting pre-approved at these new rates, they will have a different understanding of the market. They may not see as much of a frenzy. They may see a little bit more inventory. I will tell you one thing that I've noticed, just personally, and I'm a small fry. I don't want to say, I have all these deals or whatever, but I have 3 deals where the buyer has 2 different properties under contract. Now, this is unheard of. Okay, for the last couple of years, I don't know if this happened maybe once or twice, where buyers are writing multiple offers, they're getting accepted in multiple places, and they're having to figure out which one they want to cancel. Now, we haven't seen buyers have that kind of problem in recent years, so it is definitely a unique situation. And does that mean anything necessarily? Not really. I imagine all these properties that do get canceled will get back in escrow pretty much right away. But what I'm really interested to see is how it looks in a month from now, in 60 days from now, in 90 days from now. Remember, all this stuff happens very slowly. If there's going to be a shift, it'll be because the people who are getting pre-approved today in the new market, their understanding of the market will be a little bit different. So we just kind of have to see what happens with that. I do think that people are going to continue to run to real estate. Everyone I know who is sitting on cash right now, that's what they're looking at. It's Bitcoin and real estate. Those are the two, the digital real estate and physical real estate. Those are the 2 things people are interested in. And, you're seeing more and more billionaires who already have huge real estate portfolios buy Bitcoin, and you're seeing more and more people who have made a lot of money in crypto buy real estate. So it's really interesting to watch that actually take place. I would say we're still in a 100% lock immediately type situation here. If you get in a contract, if you are trying to do a refi, you need to get that in and locked ASAP. There's just no reason not to. Definitely read this thread, okay, right here. And if you want me to take a look at your situation, if you'd like to get a custom quote, just submit your scenario via email or text anytime. I only need 4 pieces of information right there on the screen. Give me those 4 pieces of information. I'll get you a custom quote, get you on your way. And what we're going to do is we're just going to hope that tomorrow is one of those days that's just a little bit better than Fridays have been.
Damn!
That's from Friday. I want to be saying that tomorrow when I see mortgage bonds. Come on, let's get it. Hey, if stocks are going to be down, 500 points, if we're going to see this kind of red tape, I would like to get what you're supposed to get on a day like that, which should be a nice little rally in bonds. But I have a feeling stocks are going to get hit tomorrow. So let's get one of those bond rallies in. Let's have a good lock day on a Friday for once. How about that? We got a few loans we could lock possibly, so that'd be a good thing. But in the meantime, I'll be here if you need me. You guys have a great night, and I'll talk to you soon.